Welcome to Chapter 7. What is a bond? There are four main objectives in this chapter. What is a bond? Who uses a bond? Bond risks, and why bond investing is very attractive. So let's get started. The first thing that you need to understand about a bond is it is nothing more than a loan. So, as I describe the following scenario, just keep that in mind throughout this chapter. Okay, so let's start off with a representative from a large business that we call Dream Hotel Empires. This is the CFO. Her name is Julia. And as a chief financial officer, Julia is responsible for making sure that any type of financing that goes through the business all runs through Julia. Julia is responsible for that, and so Julia was given a mission from CEO, the Chief Executive Officer, that she needed to come up with financing for $500 million in order to construct the company's new headquarters building. So, here is the new Dream Hotel Empire's headquarter building that Julia is going to be financing. And this building costs $500 million. So Julia have to get out and try to find out that money. So how does Julia finance a building of that size and come up with that much money for her corporation? And like anyone else, she would start at the bank first. So Julia would go to the bank and sit down with the personnel of the bank. So obviously she will be meeting with some pretty high level people for the loan of that size, 500 million. What they do is that they sit down and they would look at all the things that we reviewed in chapter 2 to 6. They do the same thing. We are assessing the value of the stock. The bank would do a very similar thing. They will look at the health of the company. That would be the first step of the bank to see even if they could lend that amount of money to the corporation like this. So let's say after Julia sat down with the representative of the bank and they determined that Julia's company is healthy enough in order to take on a loan of that size of $500 million, which is enormous. The bank decides they're going to go ahead and facilitate that loan. How the bank is going to issue that money to Julia's business is they are going to do it through bonds. And so what I did is I just created kind of generic bond here. And what the bank is going to do is they are going to make 500,000 bonds, and each one has a par value of $1,000. And what the bank is going to do is they are going to take these slips of paper, these bonds, and they are going to sell these bonds to the investors. And the money that the investors pay them through these bonds is going to be same money that the bank is going to hand over to Julia. So the bank creates 500,000 bonds. Each bond is $1,000. When you multiply those numbers together, you get the $500 million that Julia would be going after in order to build the headquarters building. So what the bank does is the bank comes up with a rough coupon rate, must to say that it's 5% based off of the risk and the internet interest rates that are all happening during the time when Julia could have gone to try to get the loan. So based off of that, they are going to go ahead and issue bond which is 5%. So Julia comes in, she is going to come back to the bank and sit down at the bank. At this point, bank has not yet issued any bonds. They are still going to facilitate the loan. They are going to go ahead and give Julia's company $500 million that they needed in order to start financing and building the building they want. After they do that, after they give Julia's company $500 million, now the bank is sitting on this 500,000 bonds that they are going to distribute and start selling to the investors. So let's go to the next step here. There is our investors on the right side on the slide. So Julia got $500 million and she is now disappeared from the bank because she needs to continue with the construction of the building. And now the bank is going to go ahead and issue starts selling these 500,000 bonds to all sorts of investors. One investors might buy 1,000 bonds, the next person might buy 100 bonds, but the bank is going to be selling each one of these bonds. And the bank, instead of charging $1,000, they might charge $1,005 for each bond sold. And the difference, that $5 difference, we call it
underwriter fee. And that's how the bank makes the money. Because they are selling 500,000 bonds, and let's say they make about $5 each, that's how the banks making their money. So investors get their bond and they pay $1,005 to get into the bond. And when they hold that slip of paper, they're actually going to receive, you see where it says coupon rate is 5%. And so they are going to receive 5% of $1,000. Okay, and the 5% goes off of par value, not the price that they paid for the bond, which is $1,005. And that is really important to make a note. So they are going to make 5% a year on the $1,000. So every single year they are going to make $50. And the bonds are typically paid 2 times a year. So if one of these investors had one bond, they would have received $25 after 6 months of owning it, and next 6 months to get another $25. And they keep getting this $25 payments for the total term of the bond, which is 30 years. And then this is also a very important part. At the very end of that 30 years, they would have received their $1,000 par value investment back, and that would be paid by Julia's company. So Julia's company would also be making that coupon payment, about 5% for each payment. After the bank sells off that bond, the relationship at that point is now between Julia and investors. So let me go ahead and recap this real fast. You can see how the flow of money would occur during this transaction. So Julia needed the $500 million and the bank supplied the $500 million. You can see that Julia received the $500 million and the money goes to Julia on the left here. And the bank now has 500,000 bonds that they now need to start selling to the investors. Now, if they don't sell all the bonds initially offered, the bank is continuing to hold the bonds and the bank would receive the coupon payments, 5% coupon payments. But if the bank does sell the bonds off to the investors, which they want to do anyhow, because they will ultimately don't want to be responsible for that sizable loan. They want to push that responsibility off onto the investors, that after that bank would go ahead and start selling those bonds off to the investors. Now investors have all the bonds. The relationship is now between the Julia and the investors. And so Julia's company is going to continue to make the 5% coupon payments to those investors, and they are going to make it every 6 months. Make another payment, keep making these payments clear up to the 30 years. So those investors who are getting paid 5% on that initial investment when they bought those bonds for 30 years. And then after 30 years, the bond becomes matured. That's really important term to remember. The bond becomes matured after the term limit. And Julia's company now has to pay all those investors, whoever holds the bond after the term comes up. They all receive $1,000 payment in par value. They will receive $1,000 payment after the bond becomes mature. And that's it. That's really all there is to it. Okay, so who issues bonds? There is really just two divisions for this who can issue bonds. One is the corporations and the others are government. So the model that I just walked you through was a corporation. The corporation wants to raise money. There is one of the options that they have in order to raise funds is to go to the bank, and the bank issues bonds. So you understand that model. When you are talking to the government level, they do the exact same thing. They go through the same steps. They go to the bank. The bank will look at their capability that the government actually has to repay the bonds. When you get into it, the state and the local level, they don't have the luxury of federal level that they can just print more money because they don't have the state dollars. They don't have the local dollars. They are using federal dollars. The state and the local government have to remain within their boundaries and watch their balance sheets and make sure that the revenues that they bring in are exceeding the expenses that they have. So when they go to the bank, and the bank is going to do the same thing, they are going to assess their ability, that the local government or the state government's ability to repay the loan and the interest rate that they would make the bond for would be corresponding to their ability to pay that off. When you get into the federal level, Charlie Munger considers this is a zero risk investment simply because the federal government has the ability and the luxury just to print more money if they need to. Now that causes inflation in the long run. We will talk about that later on as we get into some of the more advanced chapter. All you really need to know is, generally speaking, the federal government's bond is considered zero risk because they can just print more money in order to fulfill coupon payments. So, speaking about the risks associated with bonds, the thing that you really think about are these three things. First one is whether the company or the government would have a failure. Because if that company, let's say we go back to Julia's company, although she might have got a really good interest rate because maybe whenever she went in for her initial screening with the bank, everything looked like a great company, had a full ability to pay back their loans, but that's a long loan, that lasts for 30 years long loan. 15 years later, maybe you have got a new management, maybe a new board of directors, and the direction of the company has changed, become a whole lot riskier, and what we find is that the risk associated with the company has increased. Maybe their inability to continue making a coupon payment starts showing up in the market and people start trading that bond much lower because there is no anticipation that the coupon payments are going to be sustained. So the next risk that's associated with the bond is that when interest rate change the bond value, the market value of the bond also changes with the interest rate. Let's assume that you just went out and you bought 5% federal bond, and 2 years later interest rates went down to 4%. So here you are holding that 5% bond. In 2 years later, the what best people can get when they go out and buy bond is 4%. So there is an enormous advantage that you have holding a bond that is paying a higher interest rate than what people can go out and get at 4%. And so the value of your bond in the market goes up significantly based off of the change. And the last thing is that there is a risk associated with the bond, which is inflation. If you go out and you buy a 5% bond and the inflation throughout the term is about 4%, all that money you are going to make relatively speaking is 1%. So when you are figuring out the value of a bond, you absolutely have to subtract the inflation that occurs throughout the duration that you own the bond. That's something very important to understand. We will talk about all these factors much more in the advanced chapter. Okay, so I briefly talked about a company that would start performing poorly. And let's assume that you are holding a bond for a company that actually does fail, goes through bankruptcy. I know in 2009 and 2010 time frame, this was a real for General Motors company. General Motors. They went through the bankruptcy, and when something like this happens, the order of distribution for the equity that remains in that company, whenever they go bankrupt, the order of precedence is that the bondholders receive their money first, then the preferred shareholders, then the common shareholders. In the first 6 chapters, we were talking about common shares. So you are the last in the order there to receive distribution of what was remaining in the company if it would fail. So that's one of the things that truly great about bonds is that your level of risk is a lot lower than dealing with common shares, because if something bad happens, you are the first person to receive payment if there is any money is left. So that is something that you got to consider. And a lot of time when you are talking bankruptcy, there is not really too much left. So that is just something else to think about. So why would you invest in a bond? A lot of people, they really don't see the value in it because they see maybe a low coupon rate of maybe 5%. But what I am going to show you is why investing in bonds is absolutely just as important as investing in stocks. This is so fundamental to Charlie Munger's investment approach, and this is something that I really want you to pay close attention to. What I got here is the Dow Jones Industrial Average through our market crash in 2008. You can see the timeline about there. And what I did is I looked up what the 30 years federal bond rate was back in beginning of 2007, and that the bond rate was around 5%. And what else I did is, if you have gone through the first 6 chapters, you would understand what the price to earnings ratio is. And if you don't, I recommend you to go back
and definitely watch the first 6 chapters before you jump in here. It will make a whole lot more sense. So during the same time frame in 2007 or beginning of 2007, the average price to earnings ratio on the Dow Jones was 27. As you remember, if we take the reciprocal of the price to earnings ratio, that gives us a pretty generic rough estimate of what our return will be. And so taking the reciprocal, which means 1 divided by the price to earnings ratio, that would be 1 divided by 27, our return is 3.7%. So looking at the federal bond, which we already established, almost a risk-free investment, and it's making 5%. And if you would go and invest in the Dow Jones Industrial Average and your P is only 27 and you can only expect 3.7% return, it's pretty obvious which investment here is a better choice. Then that is the bond, because you can make 5% opposed to 3.7%. When you look at this chart, stocks were trading like wildfire in 2007. Everyone in the family and their kids were involved in the stock market, but yet the bond is where Charlie Munger and Warren Buffett and really smart value investors would have been, because they know that they are going to get better return on that. And so what that does, and they were not predicting anything, they are not predicting anything here. All they do is simply reacting to what is a better value, and at this point it was bond. Now as we look over the right side, let's go to 2009 and look at how the numbers change. So in 2009, 30-year federal bond is now at 2.83%, because the federal government trying to stimulate the economy by dropping the interest rates. And now we look at the average price to earnings ratio for stocks, and it's 15. So when we take the reciprocal of the 15, which is 1 divided by the 15, our return is 6.7%, almost double where it was 2 years earlier. So now let's look at that return. Bonds are now up to 2.83% and the stocks are at 6.7% on average across the board. Which one is the better investment? Well, of course the stocks are the better investment. And of course that's what Charlie Munger, Warren Buffett, Mohnish Pabrai and all the billionaires were doing, was buying up all these stocks when they were at dirt cheap prices. And they were buying companies that had very little debt. And so what they knew is that they were always on the right side of the equation. They are always investing in bonds when they should have been, and they have been investing in stocks when they should have been, because they were simply making that comparison, and that is so vitally important to understand. Let's assume that we bought a 30-year federal bond back in 2007 because we saw it was a 5% and the price was $1,000 per bond. Let's just buy one bond for $1,000 back then, so that we hold on to that bond for 2 years. Okay, and in 2009 interest rates dropped down to 2.83%, and when there is an interest rate drop, your holdings, remember we bought that 5% bonds, we were holding that 5%, and now it's 2 years later and the best that anybody can go out and find is 2.83%. But what are you holding on to? You are holding on to the 5% bond. Who does not want to buy 5% bond when interest rate to that low? So your bond becomes more valuable in the market because you are holding to 5% bond when everyone else can only get 2.83%. And so the value would have changed approximately up to $1,418. And then when you add in 2 years of coupon payments, that actually goes up to $518 you have made in 2 year period. So that's about 25% return for owning that bond in just 2 years. So that's why investing in bonds is so important, and just it's equally important to Charlie Munger's investing approach as much as stocks. Unfortunately, a lot of people don't talk about that. They really don't understand how he is doing that. But this is what he is doing. So why invest in bond then? What I just said, understanding bonds is just as important as understanding stocks. What you are going to find is that a lot of times when the stocks are really high, the bond prices are really low and of great value, and vice versa. You are going to see the exact opposite whenever the bond prices, when interest rates really low and no one is trading the stocks. That's when you really want to be involved in stocks. So that concludes chapter 7. In this chapter, we learned what is a bond, and then we learned about who uses bonds, and also we learned about bond risks and why bond is so attractive. I really hope that you understand this, and you might be thinking that I am going a little bit faster,
But stay patient, and I will put everything on the table in the coming chapter so that you will understand where I am going. Hope to see you soon in the next chapter.